This is our third in a series of sessions on valuation, and specifically in this lean finance session, we want to talk about valuation and discount rates specific to early stage companies. Remember that there's a bunch of different valuation techniques, how you value a business and investment, and it's really going to be dependent upon the stage of the company in the life cycle, and also whether it's a privately held or publicly held company. And this will show up a lot in the discount rates used that investors will apply in trying to determine, especially using net present value, their rate of return. Now remember, for startups, they're young, they don't have much of the operating history, if any operating history. It might just be a business plan that's totally based on future projections. So they don't have any operating history, no earnings, and many times when the valuation is done, there's not even any revenues. It's not unusual for a life science company, a biotechnology company, that they may not have revenues until the 8th or 10th or 15th year of business. So when this occurs, you know that there's a tremendous amount of uncertainty. Now some valuation methods, like a Monte Carlo method, will use hundreds of different scenarios and look at tons of different sensitivity analysis, and usually that probably is overkill as far as analysis. But we do want to keep in mind that this uncertainty is something that investors are very aware of when doing valuations. The two general valuation techniques that are used, and they're called different things, but for the sake of our presentation, we're going to call the first one comparable transactions, or also called comparable companies. And then the second general type of valuation for early stage companies is a future-based projection based upon the future cash flows, future profits, and incorporate maybe even some real options in real uncertain situations. For our purposes, when we talk about net present value or discounted cash flow, we're usually talking about doing a projection of the company's income statement, balance sheet, and cash flow of 3, 5, or 7 years. Most people pick 5 years because when dealing with like venture capitalists and angel investors, that's their time horizon. Now when doing your forecast, of course, that goes well beyond what we want to talk about, but there's a lot of uncertainty, and everybody knows that. So what we have to do is just make sure that we have really good assumptions and we put as much time and effort into it just to come up with something that's reasonable. Important in a net present value discounted cash flow valuation is the terminal value. In other words, instead of projecting out many years beyond year 5 or 7, let's just estimate what the value of the company will be if we sold it at the end of year 5 or at the end of the investment horizon. Usually we're going to use a terminal value that's based upon a price to earnings ratio, a price to sales ratio. It gives us kind of a general sense of what the company's worth. If not, then we'll use something like, we'll look at other companies that have done initial public offerings that are very similar to the company we're looking at, and try to estimate what the value of their equity and enterprise were at the time. Once we've done the projection, done the terminal value at the end of the final year of the forecast, then we go through the process of what we call discounting it back. In other words, taking the future cash flows or future earnings and seeing what the present value of those are based upon a market-adjusted discount rate. In other words, the rate of return, the minimal rate of return investors will want on their investment based on the uncertainty. Now when we talk about discount rates, this is one of the things that's probably very unique to early stage companies. It's very new for finance and accounting majors. It's not unusual for especially investors putting money in at the earliest stages, the seed capital, to look for a rate of return of 80 to 100% per year. In other words, a discount rate of 80 to 100%. And as you can see, as they move further along the path of the life cycle of the firm, startup financing, first stage financing, all the way to the second stage to bridge financing, where the company's got revenues and maybe profits, and you just need money for a short amount of time to do the IPO or exit. You see how the discount rates are reduced as the company gets older and more mature. Well, those discount rates are trying to reflect what the risk is that investors perceive in the business.